Debt is a financial obligation that involves borrowing money from a lender, with the expectation that the borrowed funds will be repaid over a specific period of time. There are various types of debt, including consumer debt, such as credit card debt and student loans, and business debt, such as loans taken out by companies to finance their operations or expand their businesses. Debt can also be classified as secured or unsecured, depending on whether or not the borrower has pledged collateral to secure the loan. In general, debt can be a useful financial tool for individuals and businesses, as it allows them to access the funds they need to make purchases or investments that they may not be able to afford upfront. However, excessive debt can also be a burden, as it can require the borrower to make regular payments to the lender, which can be difficult to meet if the borrower experiences financial difficulties. Good debt is debt that is taken on for investments or purchases that are expected to generate income or appreciate in value over time. This type of debt is generally considered to be beneficial because it can help individuals and businesses to increase their wealth or improve their financial situation in the long run. Examples of good debt include 1. Mortgage debt. This type of debt is taken on to purchase a home, which is typically considered a good investment because it can appreciate in value over time. 2. Student loan debt. While student loan debt can be significant, it is often considered good debt because it is taken on to finance education, which can lead to higher paying jobs and increased earning potential in the future. 3. Business debt. Businesses may take on debt to finance expansion, invest in new equipment or technology, or to cover operating costs. If the business is successful, this debt can be a good investment because it can help the company to grow and generate more income. Bad debt, on the other hand, is debt that is taken on for purchases that do not generate income or appreciate in value over time. This type of debt is generally considered to be less beneficial because it does not contribute to the borrower's financial well-being in the long run. Examples of bad debt include 1. Credit card debt. Credit card debt is often considered bad debt because it is taken on for purchases that do not generate income or appreciate in value. Additionally, credit card debt typically carries high interest rates, which can make it more expensive to repay. 2. Car loan debt. While a car can be a necessary purchase for many people, it is typically considered bad debt because it depreciates in value over time. Additionally, car loans often have high interest rates, which can make them more expensive to repay. 3. Personal loan debt. Personal loans are often used to finance purchases that do not generate income or appreciate in value, such as vacations or home renovations. This type of debt can be considered bad debt because it does not contribute to the borrower's financial well-being in the long run. Taking on too much debt can have serious consequences for individuals and businesses. Some of the potential costs of taking on too much debt include 1. High interest payments. Debt often carries interest, which means that borrowers are required to pay back more than the amount they originally borrowed. High interest payments can make it more expensive to repay debt and can make it difficult for borrowers to get ahead financially. 2. Financial stress. Debt can be a source of stress for individuals and businesses, especially if it becomes difficult to make the required payments. This can lead to financial problems such as late fees and damaged credit scores, which can make it harder to borrow money in the future. 3. Limited financial flexibility. If a large portion of income is dedicated to debt repayment, it can be difficult to save money or make other financial decisions. This can limit financial flexibility and prevent individuals and businesses from achieving their financial goals. 4. Difficulty obtaining additional credit. High levels of debt can make it more difficult to obtain additional credit, as lenders may view the borrower as a higher risk. This can limit the borrower's ability to access financial resources in the future. Overall, taking on too much debt can be a financial burden that can have long-term consequences. It is important for individuals and businesses to carefully consider their financial needs and limitations before taking on debt and to make sure they are able to manage their debt responsibly.